If you want to build long-term wealth, the single most powerful tool you have is investing in the stock market. But where do you even start? I know how it can feel simply overwhelming with thousands of stocks to choose from. But look, what if I told you there was a way to buy hundreds or even thousands of the world's best companies with a single click, and that it was cheap, simple, and perfect for beginners? That's precisely the magic of ETFs, or exchange-traded funds. And today we're focusing on a very specific type of them, the growth ETFs. These are designed for long-term capital appreciation, meaning they aim to make your initial investment grow as much as possible over time. So if you're ready to start building your portfolio, here are my personal top 5 Canadian growth ETFs to buy and hold in 2025. Before we jump in, my criteria for this list are simple. Very broad diversification, because we don't want to put all our eggs in one basket. Low fees, because we want to keep as much of our returns as possible. So all of these have very low, ultra low MERs, or management expense ratios. And simplicity. These are ETFs you can buy, hold, and not have to worry about day to day. And of course, it's not a financial advice. Do your own due diligence. So before we jump into top 5 of them, I want to talk about something important that can be a little scary, especially for new investors. I know the idea of growth is exciting. On good days or in good years, growth ETFs can absolutely outperform your wildest expectations. But the real challenge, and a crucial thing to understand, is what happens when the market isn't so stable. When there is a downturn, these same growth ETFs, particularly those with companies not yet delivering consistent earnings, can fall quite rapidly. Of course, I learned this myself the hard way. When I personally started investing more heavily around 2021 or so with Wealthsimple, a great platform for beginners, by the way. I have a video about it if you're interested and you've never used them before. Everything was absolutely booming. Interest rates were low and the stock market was skyrocketing. I genuinely felt like a genius investor. I shared the story in my Wealthsimple video as well. But long story short, I was not ready for what came next. When the market started correcting in late 2022, I believe, and very early 2023, I realized that my risk tolerance wasn't what I thought it was. Because look, it's easy to say that your risk tolerance is a 10 out of 10, when everything is going up. The real test is when things are going down, or not just going down, but tanking. This is just a little disclaimer for you to keep in mind. For example, putting all your money in a growth-heavy index like the Nasdaq might feel like a genius move when you're up 20 or 30% year over year. Amazing. But what happens if a bubble bursts or if the economy faces a downturn? Even the S&P 500 is heavily weighted by a few very large tech companies that are spending billions of dollars, and they're not immune to this market shift. Growth is fantastic, but it comes with higher volatility. It's a simple trade-off. It's a lesson from someone who has been burned by thinking their tolerance for risk was higher than it actually was. And this is also why I will be making a future video about dividend stocks, which, while they might also suffer in a downturn, are generally more stable as a rule of thumb and come from more established companies. So with that in mind and out of the way, let's get right into our countdown, starting with number 5. XAW is a perfect foundational ETF for building a global portfolio. It provides investors with exposure to over 9,000 stocks from across the world, encompassing developed markets like the United States, Europe, and Japan, as well as fast-growing emerging markets like China and India. The key feature of XAW is its exclusion of Canadian equities, allowing investors to pair it with a separate Canadian ETF, like VCN, for example, to create a tailored and globally diversified portfolio with very precise control over their Canadian home bias. This 2 ETF strategy is actually a very popular approach for Canadian DIY investors. For home country exposure, VCN is an excellent choice. It holds approximately 200 of Canada's largest publicly traded companies, including major financial institutions like the Royal Bank of Canada and TD Bank, railway giants like the Canadian National Railway, and energy companies such as Enbridge and Canadian Natural Resources. A key benefit of holding a Canadian ETFs like VCN is reducing currency risk, as you're investing in assets denominated in your local currency. This ETF, when combined with a global ex-Canada ETF like XAW, as we've talked about before, provides a simple and complete worldwide stock market exposure. Number 3 is XQQ, which is an ETF for investors looking to increase their exposure to the technology sector. It tracks the Nasdaq 100 index, which is composed of the 100 largest non-financial companies listed on the Nasdaq exchange. This ETF is a who's who of modern innovation, with top holdings that include technology giants like Apple, Microsoft, Nvidia, as well as e-commerce giants like Amazon, and electric vehicle companies like Tesla. Due to its heavy concentration in technology and growth stocks, XQQ can be a lot more volatile than a broader index. But it also offers a higher potential for capital appreciation, making it a very powerful growth tilt for a well-diversified portfolio. It's really a great way to participate in the growth of the US tech sector. Number 2 is VFV, which is considered the cornerstone of so many portfolios. It's a Canadian-listed ETF that tracks the S&P 500 index. This index represents the 500 largest and most profitable US companies and is widely regarded as the best single gauge of the US stock market performance. VFV provides a broader exposure than the Nasdaq 100, diversifying across all 11 major sectors, including information technology, healthcare, financials, and consumer goods. Legendary investor Warren Buffett has long recommended a low-cost S&P 500 index fund for most investors. And VFV provides a very accessible way for Canadians to follow that advice. It's a proven and reliable way to build wealth over the long term. And at number 1, we have what I believe personally is the single best starting point for any Canadian beginner investor. XEQT is an all-in-one asset allocation ETF. For an ultra-low fee, this single ETF gives you everything we've talked about. It automatically invests in over 13,000 stocks from the US, Canada, and all around the world, all perfectly balanced for you. You buy a single ticker, XEQT, and you're instantly more diversified than most professional investors. If you want a hands-off, simple, and powerful way to invest for growth, XEQT is the undisputed king, I would say. For those curious about alternatives, there is also Vanguard XEQT, which is another excellent and very similar option. Frankly, the key difference are that XEQT has a slightly higher management expense ratio than XEQT and a higher allocation to Canadian stocks. Overall, both are fantastic choices for a hands-off, long-term growth portfolio. So there you have it. 5 incredible ETFs that can form a foundation of a powerful growth portfolio. The most important thing isn't picking the absolute perfect one. Instead, it's starting. Open an account with a discount brokerage like Questrade or Wealthsimple. Pick the one that best suits your goals and simply start investing. Consistency is the key. So, which one of these ETFs are you holding, if any? Let me know in the comments below. If this video helped you even a little bit to kind of wrap your head around all these growth ETFs, please be sure to hit that like button and subscribe for more content. I always appreciate it and really supports the channel. Thank you for watching, and I'll see you in the next one. Take care.